right. Well, welcome to VCs on Fintech Investing. The Fintech landscape has changed a ton over the last few years, and really excited to have an amazing panel to talk about where we've gone and where we're going. So, we've gone from an era of growth at all costs to a real focus on profitability. I think we've done that across the entire VC landscape, and Fintech is no different. But where's the smart money going now? I think that's the question we all want to know. So I'm excited to have Matt Ober from Social Leverage here, Isabel Phelps from Lear Hippo, and Matt Goldstein from Dealmaker. So I'll let you guys take a minute and introduce yourselves.
Thank you for having me. Like I said, my name is Matt Ober. I'm a partner at Social Leverage. So we're a seed stage fintech firm. We're in our fifth fund, started by my partners, Howard Lindzen and Tom Peterson. Howard is the founder of StockTwits. And we're probably both most well known for being early investors in Robinhood, eToro, Alpaca, and we're excited to be here.
Awesome. And I hear you're most well known for being a seed investor in Benzinga.
That is correct. Back in my World Quant days.
Thank you. Matt?
Thanks so much. Great to be here. My name is Matt Goldstein. I'm one of the founders of Dealmaker. What does Dealmaker do? Dealmaker raises capital. But how Dealmaker does it, that's what I find interesting. Well, I find all of it interesting, but in particular, I find that interesting. You can think of Dealmaker as a love child between a Shopify-like platform, a broker-dealer that raises capital, and a marketing agency. And when brands come to us to raise capital, we run campaigns for them aimed at their customers or online footprint. So we'll take a brand that has some sort of online audience, and we'll turn that into a source of capital. We did the Green Bay Packers deal, which is one that people tend to know. Every brand out there today has some sort of fan base, customer base, Insta following, email audience. And for us, that's the center of the bullseye when we run a marketing campaign aimed at turning fans into shareholders.
And my name is Isabel. Thanks again, Jody, for having us, and everyone for joining. I'm a partner at Lear Hippo. Lear Hippo is an early stage venture capital firm based here in New York. By early stage, we invest in pre-seed and seed rounds as a lead or a co-lead investor. I'm happy to share more about what that looks like through the course of the conversation here. But again, excited to be here today.
Well, we're really excited to have all of you guys. And yeah, Isabel, I think you mentioned that giving us a kickoff kind of on the state of play of the current venture market. I think from Lear Hippo's perspective, one of the more active VCs in the New York area. Love to understand kind of what you're seeing, what the real, I think there's some froth out there in the market holistically, but is that in the VC market, and is that, have to do with market dynamics or the AI boom, or what are you guys seeing?
Yeah, for sure. Happy to talk about this. So we, for context, LH has been investing. We're one of the most active early stage firms here in New York. We've been investing for the past 15 years, and so have a kind of long-term horizon on the venture market. And certainly over the past 5 years, the market has swung pretty wildly. And so I'll give just a super quick overview on what that's looked like, and then the market today. For context, and I don't think this is news for anyone in the room, but for those of you that haven't been following the venture market as closely, there's been a particularly kind of large oscillations in the venture market again over the past 5 years or so. Between 2020 to 2021, you saw a doubling of the dollars invested into the U.S. venture market, topping or over 300 billion in 2021. That fell off a cliff in 2022, and further declined in 2023. And since 2023, you've seen an increasing in the U.S. venture market. I think it's through Q3 of this year. It's a little over 200 billion that's been invested so far this year. But I think the kind of pace and importantly, I think style of that recovery has looked a little bit different. So far this year, 40% of venture dollars, again in the US, were invested in just 11 companies. And even and those are largely kind of the big AI names that I think you guys are probably all following as well. But that's also been true in the early venture market. We've seen just increased consolidation and concentration within the early stage market. And specifically are seeing a number of deals being done that are, at 5x the valuations out of the gates that we were seeing just 12 months ago. So definitely kind of a marked difference in terms of what the market looks like today. That's in spite of more deals than ever, at least from our vantage point in terms of top of funnel. And so I think balancing those things has been kind of an interesting dynamic of today's market, and we can talk more about what that actually looks like for founders and how they should be approaching fundraising later on in the conversation. I think for us, in terms of how that manifests and how we're evolving our strategy, which I think is part of your question, Jody, our strategy has been pretty unchanged. I mean, I think the approach that we take, again, we're a generalist firm, and so we're looking across all categories, and we really are looking for founders that themselves have kind of a unique edge or insight or advantage within the markets that they're building in, and that we think have the capacity to really shape billion-dollar outcomes and tens of billion-dollar outcomes in their category. And so that approach, I think, has been unchanging, but certainly we're looking for founders that can navigate the fundraising market and navigate this kind of challenging market. And I think the other complexity here is also navigate a technological landscape that is shifting very rapidly as well. And so today, we've always been founder-driven kind of as a fund, but today we spend more time, not less, working with founders to really get a sense of their abilities to navigate what is certainly both a frothy but also kind of a challenging fundraising market.
Awesome. Yeah, I mean, I think it's really interesting to see the ebbs and flows of the VC market over the last 5 years. Matt, as you think about, Isabel just describing the institutional market, how are you seeing the retail VC market, and kind of in terms of like what kind of companies are piquing people's interest? It sounds like you guys have done a wide range of companies, but right now, where are you seeing the interest?
Thanks for teeing that one up. So before this panel, Isabel and I were talking about what kind of links us together as firms. And the reality is we both exist in the capital markets. And if we're going to use the analogy of a market, we're different, vendors, as it were, in that market. We're different places that someone who's looking for capital can go. We have different stalls. We have different sales pitches. We attract different types. So as Jody was leading me on to, we are very, very focused on retail capital. So when we have a brand raising capital on our platform, they're looking primarily for non-accredited investors, people who understand their brand, people who may have some emotional connection to the brand, people who may buy the product, people who surf their online store, which is why in my introduction I talk about this mashup between Shopify and a marketing agency and a broker-dealer. And when brands are raising capital from retail investors, they have to show up in a very specific way, and probably a little bit different from the way they have to show up when they're engaging with VC. First and foremost, we always tell them the way you raise capital with us is the way you do everything, which is build your online presence, have a value prop that withstands scrutiny from the market, have a price point that's fair, win the trust of the consumer to, if they're willing to buy your product, they're willing to buy your shares. And so we've seen a tremendous growth in retail capital raising over the past 10 years since the Jobs Act in 2012 really opened up Reg A and Reg CF. I mentioned the Green Bay Packers deal, but we put 6 companies on NASDAQ in the last 12 months. We'll do another 6 in the next 12 months. We did 2 on NYSE. We'll do another 2 in the next 12 months as well. And they do cut across all sectors. They're consumer-facing companies that have restaurants that you would know and recognize. They're B2B companies that are in a space that may be attractive for some of the people in this room, AI, robotics, lithium. But the message is the same. If you can build an audience online in order to sell a product, you can sell shares and raise capital online as well.
Awesome. Matt, you wrote recently coming out of Money 2020 that if AI is the pitch, the valuation goes up. But you've spent your career kind of figuring, kind of finding between hype and the truth, and that's the key for a VC. So how are you looking at things, knowing that there is a lot of hype around AI, but also for a VC investor, it's so important to find the real value?
Yeah, I mean, I think the reality is there's the barbell approach of what's happening is there's the extreme AI valuations we're all reading about. And, we focus a lot of our time in the fintech space for the majority of our portfolio. And I would say AI is a part of every story at this point. I think those that are raising on a pure AI story, trying to raise the most money at the highest valuations, I think those typically scare us away. I think we're looking for founders that a little bit more level set and moving a little bit slower. I think we heard a little earlier, like we're spending more time with founders, taking our time getting to know them. We'd rather they take less at a lower valuation. A typical investment for us is at sub 10 million. We're hearing, early stage companies in San Francisco raising 10 million right out of the gate without a product. So probably not an area that we're going to be chasing. We try and educate the founders that, not every company is going to have a multi-billion-dollar exit and go public. And so give yourself optionality to one day be acquired for 500, 600, 700 million. And that's a great outcome for both the investors and for the founders. So that's typically where we spend our time. I would say probably as busy a summer as we've ever had in terms of number of companies that are raising money. It's just kind of, finding what the right people are that you want to invest in.
So it sounds like, founders is a big theme, I think, always for VCs, and kind of, as you evolve. But one other thing I heard, and, Matt talking about the Shopify for capital, it really makes you realize that the capital raising strategy is often, I don't want to say as important as the company itself, but a key factor in how the success of a company. And, Isabel, you mentioned it even as you think about kind of how you look at founders, but maybe dive into how you see the capital raising strategy as part of the equation.
Yeah, so for us, capital raising is not a separate strategy from building your company. It's all one strategy. If you're a founder and you have a product that you want people to buy, then you have to do all of the things that are necessary in the checklist to raise capital as well. You have to have a story, you have to find the right audience, you have to tell that story effectively, you have to be priced fairly, as Matt was alluding to as well. You have to have credibility. It helps if you have a track record. All of the, you probably have additional items on your checklist as well when you do due diligence on a company, but effectively, our perspective is for the online audience to buy your product, you have to do all of the things that you would have to do in order for them to buy your shares as well. So for us, it really is all one thing. We make capital raising or share ownership part of your commercial strategy. The Green Bay Packers example is the one that I think everybody connects with. You give the fans a chance to be owners, and then boy, do they become super fans. You see the impact in your merchandise sales. You see the impact at the stadium, at the ticket gates. They go on LinkedIn and they put their job title, owner, Green Bay Packers. So you see a real coming together of a commercial strategy and a capital raising strategy. Might be a little bit different in your world.
Yeah, happy to speak to that. I think certainly, the overarching point that fundraising strategy should be approached as part of your overarching strategy, number one, and number two, that there is no one size fits all, I think is very much true. We see, and I would say that for venture specifically, venture capital is an incredibly potent and powerful tool, highly scalable, and it's driven really phenomenal outcomes for all involved. It's also expensive as a form of capital, and I think that I think that all founders are really should kind of take some time and really think for themselves around what is the right form of capital for my business. And if that's, and I think having actually taken that time to think that through and really formulating that strategy, I think will actually make you much better positioned to ultimately pitch investors or venture investors if you decide to go that path, or other investors as well. But I think too few people, opt for venture without fully thinking through what is the right way to capitalize this business. I would say that when that said, again, venture can be an incredible tool. And I would say when thinking about raising venture money, I think our perspective is that working with institutional venture investors who understand the nuances of kind of private companies and understand and have the patience for kind of like managing those companies as they evolve. And it now takes on average 11 years for an IPO, kind of, I think it's above 500 million, right? And so like it takes a level of patience and commitment and nuanced understanding of those businesses and how they evolve. And we think it's really important to find an institutional investor that understands that. But even from our vantage point, when we're investing in a round, we take roughly like 10 to 12% ownership with an investment. There's a significant allocation of that round where we're sitting down with the founder and thinking through what is the other kind of like strategic capital that we can be bringing in here. In addition, we know what we bring, but what can really complement that? And to Matt's point, I think often those are individuals who can open doors to, in terms of distribution, in terms of partnership, in terms of talent networks, which is an incredibly kind of important piece of the puzzle for early stage businesses. Open, doors for other investors down the road as well. So we're always thinking about kind of how can we bring in a highly strategic group of investors on any given cap table, even when venture is involved.
Great. I think it's, definitely seems like it's part of the cohesive strategy, maybe part of the staging as well. Matt, I turn to you. Curious, you guys are an institutional investor, but you also kind of sit and look over a retail social trading platform. So bring both worlds together. How do you see these two markets kind of coming together, or two different capital components of the same market, I should say?
Yeah, I mean, I think we obviously we're early investors with Howard building StockTwits out. So I think for us, it's been just a great source of new deals that we're seeing and companies that we're investing, but also like where the retail trends are going and what's been important to them. Obviously, prediction markets have been a boom over the last couple months, both for sports betting, but integrations into Robinhood and just where all of that's going. And obviously the crypto markets as well. So for us, I think, the investing, I tell a lot of founders to not take venture money. And maybe this goes back to, knowing who you're taking money from. I think there's a lot of businesses that are going to be great companies, but you have to put your hat on what the VCs are trying to ultimately accomplish, right? Like, are they looking for 100x returns on their money? Like, do you really want that? We're thinking about a 10-year journey. Are they hoping to sell the business in 3 to 4 years? So I think there's a lot of times that people think that they want to raise venture money and it's just not a good idea. And when I point them to, maybe that's from retail, maybe that's family offices, that's angels. But I think raising venture money comes with a lot of, there's a cost to it. Obviously, it comes with a lot of resources, but it also comes with, a lot more, overhead of thinking about, like, you now have investors that have expectations.
If only there was a platform you could send them to that could help them raise capital from retail.
Yeah, no pressure from those investors, I guess. A little different. So I guess as we think about where we're investing in the fintech space, whether it's the intersection of AI and fintech, I'd be curious, how you're looking at it. Isabel, I know you have like even some companies here today talking, but like, what are you seeing in the fintech space specifically that piques your interest as a VC?
Yeah, so maybe first I just want to root this in kind of our overarching strategy. Again, we're a generalist firm, and so we invest across categories. Certainly, fintech is a substantial one, especially being a firm based here in New York. But we really look to take a market agnostic view, and again, are really looking for founders that whatever domain they're building in have just a real edge within that space, and obviously that we think can ultimately generate venture returns. That said, I think there's been a number of companies that actually have invested in just over the past 9 months, specifically at the intersection of fintech and AI that we're really excited about. Some within the agentic commerce space, and one that I think Jody was alluding to that's going to be presenting later today. It's a usage and payments platform for AI. Highly recommend people sticking around for Mitchell's talk from Lava if you have time. We're really excited about that one as well. But again, we really are looking for founders that kind of have a unique perspective as opposed to chasing a specific industry or vertical. And I would say that the honest answer, to this right now, for me personally, is that I'm actually seeing a fair amount of consensus around certain topics. And the pitches that get me the most excited right now are the ones that I have not thought of, that just seem weird and different, and like someone has a different perspective that I think we as a fund are most excited about.
That's great. Matt, you mentioned recently in some of the stuff you've written about tokenization and wealth management as being kind of some of the places you're looking to invest, or you see a lot of green shoots. What are those most tangible investable opportunities that you're seeing in the space right now?
I think similar to what was just said, I think non-consensus, which is something I've written about a bunch, is where we've probably had the most success over the last 15 years, is like investing in things. We've been investing in wealth management and wealth tech for 5-10 years. I think when I brought it up to a few of my friends in the industry 5 years ago, it was, wealth management isn't investable. I think now it's still interesting. I think that there's a lot of noise, but, there are thousands upon thousands of independent wealth managers out there with, needs for new technology. So whether that's, AI workflows or just making everything more efficient. We invested in a company called SyntheticFi, which is bringing a unique lending product to the market using the derivatives space called box spreads, which, was interesting to me because I'd never thought about it as a tool for advisors. It was always something I saw in the hedge fund world. And then I think in tokenization, I think everything, if you listen to like what Vlad is saying at Robinhood, that everything will be tokenized. We're starting to see that with stocks in Europe. We were an early investor in Alpaca, which has built really tokenization infrastructure. And I think that that's just going to continue to expand. And so whether that becomes real estate or other things throughout the US, we're trying to take a 10-year view on where tokenization is going, and seeing some of these non-consensus or unique approaches to that is exciting.
Well, that's great. I guess the other Matt, tokenization, I think of that as possibly being an opportunity kind of in the infrastructure of how Dealmaker builds. How do you guys think about it? Is that something that kind of plays into your strategy? How do you guys see tokenization?
We pay very close attention to it. We see it more powering the trading, the secondary trading of stocks and bonds. We don't see a ton of tokenization. Like, I'm not entirely sure what problem it would solve in primary offerings. The T0 concept, I'd be interested in your views because you've given a lot of thought, and it is something we're paying a lot of attention to. But, the T0, the reduction in settlement time, the automated settlement of trading, like none of that's really a problem in primary when somebody is buying shares in a private placement or a Reg A or a Reg CF through our platform or one of the others. You buy it on credit card, the settlement is instantaneous. So to the extent tokenization unlocks liquidity solutions for private companies, I think that's where our two businesses could connect. Because if you are not going to trade in the public markets, you do need to trade somewhere, even in our business, which is primary. The expectation of investors who buy into private placements is that they will be able to have liquidity at some point. So that's a trend that we're paying attention to. So yeah, those are my thoughts. Be curious.
No, that makes a lot of sense. I mean, I think having spent a lot of time around founders in the VC community, primary is always the first focus, but then very quickly here's that secondary, and how do you turn these primary assets into liquidity? So I think tokenization can provide a pretty interesting.
Well, I think they're linked in that more people will invest in primary offerings if there's high confidence that they'll be able to get out. So with private staying private longer, with IPOs really, I wouldn't say slowing to a trickle, but kind of reducing in breadth and focusing on a certain type of initial public offering. I do think the capital markets needs a solution that provides liquidity for privates, and that'll link together primary and secondary.
Yeah, I mean, Matt, you said you look at a 10-year horizon. I think there's, especially as you think about converting to the retail investor, 10-year horizon seems like a very long time. So creating solutions that can shorten that probably advantageous.
Yeah, I mean, I think if you're at the seed stage, you kind of have to think of a longer horizon, right? If you think about took Robinhood 9 years to go public. eToro went public earlier this year. I think it took 14 years. So the reality is, if you want to go all the way to an IPO, it's not going to happen in a short time frame. I think also a lot of seed investors are thinking about QSBS, which from a tax perspective, you really only unlock that after 5 years. So I think, a 5 to 7 year journey is, the minimum for like a successful seed stage company.
All right. Well, look, as we kind of wrap up here, I think wanted to bring it back to the panel's title and really talk about if you had, I mean, you guys all sit on lots of access to capital, but thinking about if you had, $100 million and you had to do it in the fintech space, like what is it that would be drawing your attention? Isabel, you want to start us off? Like what's the lane you're most excited for?
Yeah. It'll be repetitive, but I think that's because it's very much true to how we operate. So earlier this year raised a $200 million fund, and it's our ninth. And we had the chance to really kind of reset and think about what it is that we wanted to do with that capital, and really came back to the strategy that I've already shared with you all today. We think that this is a tremendously exciting time to be building. I talked a little bit about the challenges around from a just kind of fluctuations in terms of the financing market. The best founders can work through that, and at the same time, there is just a huge amount of exciting technological shifts and industry transitions that I think create an enormous amount of opportunity as well. And so, but I think what we think is most important there is being able to invest in founders that are really seeped and kind of in and of the industries and the categories that they're in. And so for us, it's about, continuing to maintain that founder-driven approach that allows us to partner with founders that really have kind of the right to build that next category defining business in whatever category they're in, as opposed to being kind of thesis or industry specific.
Yeah, I mean, that's something that you guys have done so well, is kind of focus on that strategy from day one. And, as the market has ebbed and flowed, and as the type of businesses you invested in, that strategy is kind of held firm. So great to kind of see that. Matt, you're not going to have $100 million yourself. You're going to have 1 million people with $100, but where are they going to place their bet?
Well, can I go back in time 5 years and deploy? Because I think I can make some smart bets. I will say, as a generalized trend in the capital markets, when the book on this particular era of capital markets activity is written, if at that time anyone is still reading books, I think a big story will be we are living in a golden age of retail investing. 5-10 years ago, you saw that trend coming. Hats off to you, because the absolute explosion of retail trading and retail participation in the capital markets, I think, is still in its early innings. It's come a long way, and it's got a long way to go. So I do think, you mentioned some of the retail brokerages who are now publicly trading. There's more to come, and that is a big piece of infrastructure that I think will continue to bear fruit.
That's great. Yeah, I mean, look, Benzinga, 15 years ago when it founded, kind of bucking the trend of the institutions and trying to retail investor. And now it's all come full circle. We're kind of in one community where it all comes back together. Matt, I'll leave it to this. This is maybe a little off script, so I hope you don't mind. But, so much we've talked a lot about AI and where it's investing. But as you think about investing in companies, how do you think about their use of AI and changing the way you look at businesses, knowing that there's, I think, so much more opportunity? We talk about the first, like, one employee, $1 billion company, but how do you guys think about, like, a company, a founder's vision for using AI in their business versus being a AI business?
I mean, I think it's exciting to be a founder because from an efficiency perspective, you can have less people, you can get more done, you can move quicker. I think we're seeing revenue scale much quicker than we've ever seen before with these AI companies. I think our most exciting investments are teams that are using AI to build like data and information services businesses that, once took 10,000 people offshore manually collecting things and cleaning data. Now they're doing that with 35, 40 people. So if you think about revenue per employee, it's tremendous to think about like what that will look like in the next 5-10 years. And I think, if you're not using AI as the headline of what your business is, like AI for X, underneath the hood, there should be 1 million use cases on why you're going to be, faster, bigger, stronger, and more efficient over the next couple of years.
If I can just add to that, I think that's very much true in our experience as well. But the bar has risen. Like, I think that not only is it the expectation that you're using AI and to drive a significant amount of efficiencies within your business and to move faster, but it's also the case that the expectation is that that is a rate that is accelerating. And I think that we're seeing that from a competitive perspective. Today's market is more competitive than any that I've seen when it comes to kind of like early stage operating. And we spent a lot of time kind of thinking about how our founding teams able to build more of an enduring edge around how they're executing their whatever they're building, and using technology to do that is a big piece of it.
Well, this has been great. I thank you guys, Matt, Isabel, Matt. Really appreciate your perspectives, and thank you for your time. Thank you, guys. As we went from VC, we're going to move on now to deal making in fintech. What to expect as you go from primary to secondary. I think we teased it out here, but
Should I stay?
yeah, you can stay. We can tokenize the whole thing. So we'll just tokenize the next panel and move on. But no, thank you guys so much, and we'll invite up the next panel sponsored by Cohen Resnick.
Thank you.